Diane, you were off by 9,000, pretty close. What made you think we were going to come in light today?
Well, we've seen a bit of a slowdown out there. The ADP report is not a good forecaster of what's going on in the national economy. And I do think it's important to look at what's going on in some of what had been the drivers of gains. One of the biggest drivers of gains have been professional services, which has slowed down quite markedly this year. That had over 1.5 million more than February 2020 levels, now significantly higher than that. That is one of those sectors that saw a huge hiring spree and has now cooled off. So we're seeing some of those larger firms, which was really in the ADP report, was smaller firms are picking up the slack, where larger firms are now laying off workers. We saw that in the ADP report, and I think that's what you're seeing come out in the numbers as well. But the important issue is job openings are still far outstripping the number of workers we have. And I agree wholeheartedly with Steve, is that we're still short on workers. And that's one of the reasons why wages have not cooled even more.
Diane, when I got a 97 on an exam, my dad asked me why I missed by 3. So I'm not going to ask you why you were off by 9, okay? But just to be clear, I do want to ask you this question.
It's luck, Steve, and you know it.
Yeah, I think it's some good forecasting by you, Ms. Swonk. You've been doing this for quite a while. But here's the thing. I went back and did a little deep dive on the ADP versus the BLS. One big area where they missed, and I noticed this immediately at 8:30 when I was in the Octobox, was, and it doesn't inhibit my ability to think, being in that Octobox, but here's the thing, was the travel and leisure and hospitality.
Yep.
ADP put in 200,000 plus, the government at 21. Do you believe that? Which one do you believe more?
I believe it's somewhere in between.
Okay.
Because we know this is a month that the seasonals we're supposed to be hiring up. Okay. And we know that I happen to be at O'Hare on July 1st at 5:45 a.m. And I can tell you, at O'Hare Airport on July 1st at 5:40, yeah, it was brutal. It was absolutely as packed as I've ever seen it. And sure enough, the TSA throughput numbers show record numbers since July 1st. So we do know that hiring up in the leisure and hospitality sector was going on. And my guess is we might see some upward revisions to those numbers. The fact that the gains were not in food services. That's been a place that's been very, very strong. Instead, they were in amusement, recreation, other parts of leisure and hospitality, not usually, and accommodations. But I think we're going to see more of that going forward, and we could see some catch up in those numbers.
It's the big splurge fun stuff that people want to do, right? I mean, is this still a post-pandemic transition?
You're a road warrior, right?
Yeah, absolutely.
If you tell me that the airline business and the hospitality doesn't need hundreds of thousands of workers in this country, then I have a plane to sell you or something like that.
I mean, the flights are packed.
The flights are packed. Everything, there's a line everywhere. So it just strikes me.
The bars are suspiciously packed in the airports at 8 a.m. or 5:45 a.m. I've always wondered about that. That might not be a trend in the jobs report, but it's something I noticed when I was
Let's ask Diane about the Fed, though. So what's the Fed do with this? You heard Goolsbee, who says we're on the golden path. Are we on the golden path, Diane?
Well, you know, I'm closer to it than I was, Steve. I really thought we were going to get a recession out of this, and I can only hope that he's right, and I'm rooting for him to be right. I think we're still going to see another 2 rate hikes this year, and the Fed holding rates high until May of 2024. That is when I think they're going to be cutting rates, but not going to be cutting them back to the lows that we had seen pre-pandemic. And I think that's really important theme that we have going on out there as well, is that service sector inflation is still with us. It's cooling. The good news is it's coming down. It's not coming down as rapidly around the world as we'd like. And we've seen many central banks have to go back in and restart rate hikes even after they pause. Canada, a lot of other countries, many Nordic countries having to go back in again. And I think that is very important, that the Fed is looking at this. They don't want to get too far ahead of themselves. They don't want to make the mistake that other banks have made, nor repeat the mistake of the transitory sort of inflationary view they had in 2021.
Diane, I wonder, you know, I'm far from an expert, as you guys are, but it felt to me like a rate hike in the end of July was sort of baked in. Once we saw Steve bring us the Fed minutes earlier in the week, we knew that the Fed was thinking rate hike more likely than not, right? So I wonder today if we saw anything in this jobs report that would change the Fed's thinking beyond what they were already thinking in terms of what we saw in those minutes.
I don't think anything changes today. I think one of the interesting issues is although, you know, I give a lot of credit to Austin Goolsbee and what he's brought to the Fed and his views, and have to agree with him to some extent. That said, I do think that the acceleration that we've seen 2 months in a row in leisure and hospitality wages and a re-acceleration in manufacturing wages are things we need to watch for. We're also seeing a lot of contract negotiations go on out there, and what they're worried about is that we get CPI baked into those contracts. That is starting to happen in Europe, and you just don't want to have that indexation to be baked in because it can give you a residual inflation effect. It still is that wages follow inflation.
I was going to say,
exactly.
Diane,